The Commerce Department released data on U.S. economic growth in the fourth quarter, showing GDP rose at a pace of 2.3%, while economists, they were expecting 2.6% growth. Here to break down this data, we've got Lauren Saidel-Baker. She is the economist over at ITR Economics. Great to have you here in studio with us.
Thanks, great to be here.
As we think about this data and the reading that's come in, of course, year over year slippage, though it was growth, and then sequentially also some slippage there. What do you make of this print?
Overall, we know that our economy is growing slower. This is really a normalization. We're still feeling kind of those ripple effects post-pandemic, only just getting back on our feet now to get fundamentals finally coming through. So the good news is we can see what the leading indicators are saying, and they are saying growth is there, growth is stable, especially as a lot of this growth was driven by the consumer. Now, not all of it, some more came from the government spending side of things, which is worrisome for other reasons, but generally we have a stable consumer. We have them still spending, right? The ability to spend is there, and that accounts for 2/3 of GDP. So at the end of the day, yes, slower growth, but growth nonetheless.
You mentioned the government spending side is worrisome. Why is that?
We quite simply spend beyond our means. We have done that for a very long time. I mean, we haven't had a balanced budget since the Clinton administration. So this is a long-going problem. We've known it's a problem for a while. Our government certainly can kick the can down the road further, but eventually this probably will come to be a problem. In the very near term, with these relatively higher interest rates, this larger debt burden is certainly accelerating our interest payments portion. So spending can kind of spiral at that point.
It's interesting, especially as you kind of read through the commentary. Economists will come out and say, hey, the economy is holding up just fine. And then you have politicians that will come out and say, everything is broken and it needs to be fixed. And so what do people really need to take away, and how do they kind of just stay measured in their analysis of the data that's coming through?
Well, that's a politician's job, right? It's to take data and make the data say what they want to say. That's why we can get the same data release be taken by very different sides of the aisle in very different ways. So that's why my firm, ITR Economics, we are apolitical, we are nonpartisan, because the data is really what's telling us the story. And that's why it's important to read through some of this noise. We will get a lot of noise. We've certainly heard so much grandstanding on tariffs, on these other potential growers of the economy, shrinkers of the economy. I see this really as a risk to inflation, more so than economic growth. The good news is, according to our analysis, the economy sees through political parties. No one performs materially better and statistically significantly better on terms of GDP basis, industrial production, the big things.
What's the good rule of thumb for folks to keep in mind? What pace do we generally want to see the economy growing at on a quarterly or even an annualized basis?
So there's no magic number here. Really, we see quicker growth, we see slower growth. It's those waves, those ebbs and flows, but I don't think there's a stall rate for the economy. So seeing us around 2%, maybe 3% by the end of the year, I do expect slight acceleration by 2025, certainly 26. That's all good news.
We get some more inflation data out tomorrow. PCE, of course, this is the Fed's preferred inflation gauge. What can consumers expect to see there, and perhaps the read-through on what they've already done in contributing to spending?
I think everyone feels these higher prices. We hear that time and again in our consumer confidence indicators, but really the general trend is disinflation. Now, that means a still positive but slightly lower level of inflation. That means consumers are still feeling prices rise, they just aren't rising quite so rapidly as they had been. So this is a little bit of a balancing act. It's good news and bad news both for the consumer. The really good news is that our wages, net, are outpacing inflation, so we are in a better purchasing power position. But if you're looking at the price of eggs in the store, it doesn't feel so great today.
You foresee prices rising later in the year. How bad is that, or how much of a knock-on effect will that have for the economy?
I do see pricing rising. And again, one of the key drivers there is the wage side of things. So we're in this very interesting dynamic where I'm earning more money, but things also cost more. It doesn't always feel like my money's going as far, even if numerically, right, the data say that our wage inflation is still outpacing CPI. So I do see inflation coming back for very fundamental reasons. I think anything like tariffs or these other Trump policies could be an upside risk to that, but the full amount of inflation, that is not going to be all this administration's fault.
We also track, of course, the consumer confidence reading, where confidence is, where sentiment is, of course, coming in from two different entities, Michigan and sentiment versus the confidence and the conference board. So why is consumer confidence still lowering if the economy is showing signs and is continuing to be resilient from what we've heard?
I love to follow this indicator because it turns out to be actually a terrible leading indicator for everything from retail sales, GDP. I don't think our consumer does it maliciously, but they like to respond to these surveys and then they turn around and they do the exact opposite thing with their spending. So I don't put much credence in these, except to say the differential here, it is certainly widening. The data, the hard numbers, right, telling us one thing. Consumer confidence certainly going in a different direction. That has political implications, but as an economist, I won't touch those.
Lauren, thanks so much for taking the time. Excellent breakdown. Appreciate it.
Thank you.